Have you just sold your stock and made some money? Well, just like when you make money at your 9-to-5 job, the government wants a piece of your earnings. And unfortunately, they're gonna take their cut. Yes, I'm serious, and so is the government. So what's the idea here? The profit you make when you sell your stock is called a capital gain, and it's subject to taxes, just like many other kinds of profits on a lot of investments. But we're barely scratching the surface here, so be sure to watch to the end to know all there is to know about capital gains taxes if you're worried that you might be hit with a tax bill next year. To start today's video, what are capital gains taxes? Capital gains as they pertain to stocks occur when you sell shares of an individual stock, of a stock mutual fund, or a stock ETF for more than you originally paid for the investment. Let me give you an example to clarify things. If you buy stock for $2,000 and sell it for $2,500, you have now made a $500 capital gain. That gain is subject to taxes. Get the idea? But here's the thing. If you own a stock and the price goes up, you don't have to pay any taxes just because it went up. Rather, here in the US, you actually only pay taxes on stock investments that increase in value if and when you sell them. That brings us to realized gains and unrealized gains. And this is what you need to note. A gain is not realized until the appreciated stock investment is sold. For example, assume you buy some stock in a company and a year later it's worth 20% more than what you paid for it. In this case, though your investment has increased in value, you will not realize any gains or owe any tax unless you actually sell it. Moving forward, the IRS classes capital gains into two main categories for investing and taxes. There's long-term capital gains and short-term capital gains. On the one hand, long-term capital gains occur when you sell an asset you've owned for longer than a year. On the other hand, short-term capital gains occur when you sell an asset you've owned for a year or less. Let me give you an example. If you bought a stock on January 1st of 2021 and you sold it on January 2nd of 2022, you owned it for more than a year. Any resulting profit is taxed as a long-term capital gain. It therefore means the gain is taxed at the long-term capital gain tax rate, which is lower than the ordinary income tax rates for many investors. Speaking of, long-term capital gains are taxed between 0% and 20%, with most individuals paying around 15%. On the other hand, if you bought a stock on January 1st of 2021 and sold it on January 1st of 2022, you didn't own it for longer than a year, so it's a short-term capital gain taxed at your ordinary income tax rate, which is usually more than the long-term capital gains rate. In other words, there is no different treatment for tax purposes in this case, since you didn't hold it for over a year. Get it? Just a date makes a whole difference in how much you pay, and this could substantially be thousands of dollars once you become a seasoned investor. And as you become a more seasoned investor, this is going to be very important for you. Another super important thing to do is subscribe to the channel, because it is scientifically proven that when you subscribe, your net worth goes up. I mean, look at the graph. You can't argue with the facts. It's science. But on to the next thing. My personal preferred method of investing is long-term investing, which means I'm buying and holding stocks for the long haul, usually 10 plus years. And the reason for this is because I want to keep more of my money. I don't want to have to give up a lot more to the government just because I didn't hold it for more than a year. And when I invest like this, I'm also giving my stocks more time to appreciate, but that's just me. For example, when it comes to day trading, which is another trading strategy, in that case, you would be taxed at short-term capital gains rates. And so day traders end up paying a lot more than long-term investors in taxes. It's just a little something to note. I've actually made a full investing tutorial on how you can start investing in stocks, and I'll be sure to link it down below. But now, what if you get negative capital gains? Investing will sometimes lead to losses. You may buy stocks worth $2,000 and a year or two later, you sell at $1,500. Sometimes it happens. In this case, you've lost $500 from your initial investment, also known as a capital loss. So what happens when you now have to file your taxes at the end of the year? You could say that there's a silver lining in this situation, as your capital losses actually reduce your capital gains, and consequentially, the taxes you owe the government. What do I mean by this? You've made a capital loss of $500 when you sold your stock for $1,500. Now let's say you have a diversified portfolio, which you should if you want to minimize your risk, and you've made a profit of $3,000 from other stocks you've bought and sold. In this case, you will deduct your $500 loss from the $3,000 profit to get your net capital gains. That means your taxable capital gains for that year will be $2,500. Simple, right? That said, there's one thing to remember in all of this. You can only deduct your long-term losses from your long-term gains before you can reduce your short-term capital gains. The same case goes for short-term losses, in that you'll first need to subtract them from your short-term gains. This is another strategy a lot of investors use towards the end of the year when they're saying that they're gonna have to pay a lot of taxes. In some cases, investors will go ahead and sell stocks at a loss at the end of the year in anticipation for them already kind of having an idea about how much they're going to have to pay. And this helps them quickly reduce what they'll end up paying the government on their tax bill. Now let's take it a step further and say your capital losses for a said year far exceed your gains, as I'm sure a lot of people have lost with all these rug pulls and whatnot. But in this case, you're allowed to use your losses to reduce your taxable income. However, you can't deduct more than $3,000 or $1,500 if you're married and filing your taxes separately from your spouse. So, if your losses are above that, the other option is pushing them to the following year. Next, we're gonna talk about how you can reduce capital gains taxes on stocks. We all hate taxes and wouldn't mind learning ways to keep the tax bill at a bare minimum. And the good thing is that there are actually ways you can do this without breaking the law. Some strategies that could actually reduce your capital gains taxes include: 1. Using capital losses to reduce your gains. I've already covered this option. 2. Choose tax advantage retirement investment options. Think Roth IRA, 401k, traditional IRAs, and so on. And comment down below if you want a full detailed video on creating one of these accounts. I invest in a Roth IRA. And 3. Wait for more than a year to sell. This way, you pay reduced tax rate as your gains are classified as long-term. Something else to consider is the wash sale rule. Avoid breaking the IRS wash sale rule. That is, selling a stock for a loss to get a tax advantage only to buy the same stock within 30 days. This rule is just that. You can't sell a stock just to get the tax benefits and then buy it within the same 30 days and still get those same tax benefits. That said, taxation is a key component of financial literacy and can actually help you save money and avoid problems with the law. If you're starting your journey to stock investing, keep this knowledge in mind to help you file your taxes correctly and make sure that you file them on time. Now, thanks so much for watching up to this point. Make sure to smash the like button and share the video because it really helps out the channel. And if you like making money and growing your wealth, hit the subscribe button and turn on notifications so that you never miss an upload. So, what has been your experience with stock market investing? Ever had issues filing capital gains taxes? Drop a comment below with your experience to continue the conversation. Thank you so much for watching. I appreciate you and I hope you have a good rest of your day.